The Real Investment Show.
So welcome back to the show this morning. I'm your host, Lance Roberts. Of course, it is the Real Investment Show. Interesting stats right now. Dow Jones Industrial Average up 2.96%, S&P up 2%, NASDAQ up 0.33%. And that's since November the 1st. Now, think about that for a second. The market's gone literally nowhere since Thursday. We were just talking about this a second ago, Thursday of week before last, when we had that weaker than expected CPI report. And that was following a 5.5% bounce in the index. And yet, here we are 21 days, 22 days now into November, and the market's only up 2%. So we were recovered. That 5.5% advance recovered a 3% loss going into that CPI report. So again, it seems like that this market rally's been doing well here over the last several weeks. We all feel better. Thank God the market's going up here a bit. The kind of that grind that we had in September, where it was just every day seemed to be lower, has gone behind us. But again, there really hasn't been a lot of progress in the markets for the month of November. And the problem with that, as we've talked about before, is that, we go through these cycles where markets get very oversold. And we talked about this back in September. Extreme negative sentiment, all of our indicators extremely oversold. We talked about our MACD buy signal had gotten very, very oversold. It's at very low levels on a sell signal. And that turn was like fuel in a gas tank. And so you get in the car, the tank's full, and you step on the gas and you've got a long trip ahead of you. Well, that's the way the market works. When you get these extreme oversold conditions, you get this kind of a full gas tank, and allows the market to rally. The problem is that the markets have rallied now, and we've used up a lot of the gas in that gas tank. In other words, we're closer to the destination of this trip, not the beginning of it. And this is why I was talking about just a second ago about, continuing to use this rally to, raise a bit of cash, reduce some equity exposure risk. It's likely that, we've got some more work to do before we get to the end of this kind of bearish market cycle that we're in. But this is also going to have a lot to do with the Federal Reserve, of course, what they do in terms of monetary policy, the much vaunted pivot, right? So are they going to pivot their policy anytime soon? What does that mean? And then, of course, what does that mean to the markets and the economy and everything else? So joining me this morning to talk about all that, Michael Lebowitz. Good morning, Mike. Welcome to the show.
Good morning. Great to be here on a Tuesday.
Yeah, it's easier than a Thursday, yeah.
Especially this Thursday. It's funny that when I kind of think about this rally, which kicked off on CPI day, and like you said, we were up, 4 or 5%, they're 3 to 5%, something like that.
5.5.
Or the NASDAQ, I think, was up 5%. Yeah. But the premise for the rally was pivot. And it was pivot because CPI was a little lower than expected, and then PPI followed with a similar type print. The problem with the whole premise, and that's one of the reasons we were a little skeptical of the rally itself, was because it's based on a pivot. So you have to ask yourself, well, why would the Fed pivot? What could happen that the Fed would pivot? And when you really think about it, for the Fed to pivot over the next few months, called 3 to 6 months, it's not good. You don't want to pivot if you hold equities. It would happen. They would pivot because inflation drops like a rock, which is good news. But if it drops like a rock, it's most likely because economic activity or economic growth, GDP, is dropping like a rock. Mm-hmm. Or that's one case for a pivot. The other case is, like we keep mentioning, something breaks, what the Fed calls financial instability. And right now, there's no signs that there's financial instability in the system. Yes, there's some cracks in the facade. You see it abroad with the UK pension funds. You see it, even I think things like this FTX crypto problem. When you pull liquidity, you start getting problems, and it's showing up in crypto space. But again, these aren't problems that the Fed is even really staying up late at night, even talking about or worrying about.
Yeah,
and economic.
But importantly, though, that's the way it always is, right? I mean, there's never any. Remember, let's go back to 2007, early 2008. Ben Bernanke, everything's fine. Goldilocks economy, subprime mortgages are contained, right? We heard that a bunch through the first half. Bear Stearns collapses. They get sold off for $2 a share to J.P. Morgan. Don't worry about it. Subprime's contained. Even though subprime had its fingerprints all over Bear Stearns, it was contained. At least everybody thought it was until it wasn't. And that's the problem with financial instability. It's not, you don't have like raging financial instability and everybody knows it. And then the Fed goes, hey, I think I'll fix that.
Right.
It's kind of like, hey, there's not a problem. Then there is, and then they have to fix it.
And here's the problem with subprime, and I can link this over to crypto. The problem was not subprime mortgages themselves. The problem was that they created a whole bunch of derivative securities and a bunch of leverage based on those subprime mortgages. Mm-hmm. So I don't remember the number of subprime mortgage, but the amount of exposure to subprime mortgages was multiples of subprime.
Right.
So Bernanke's out there saying, oh, everything's fine. And what he's probably thinking is that, okay, even if 50% of those subprime mortgages collapse, it's, as a part of the economy, it's not a huge deal. What he failed to factor in was all the leverage and the derivative exposure, which they can't calculate.
Right.
No one knows how much that is. And that is potentially one risk with crypto. It's not that what do they think there is? I forgot the number. The amount of crypto outstanding, Lance, do you know it? The market cap?
The market cap on crypto as of November the 21st was 2.9. I just actually put a tweet out on this morning. The market cap in crypto, and this is all of crypto in terms of its entire market capitalization in November of 21, right? So just exactly 1 year ago today, was $2.9 trillion. It's now $800 billion.
Okay, so if Apple were to drop a couple points in a day, it's the same.
Yeah.
It's a similar market cap, right? So you're
right.
saying, okay, so what? Apple drops 2 points all the time. I think it dropped 2 points yesterday.
Right.
There was no harm. The problem is what we don't know is how much leverage, how much bank lending underlies some of the crypto and these derivatives and the infrastructure and everything else. And look, I don't expect crypto necessarily to be that financial instability.
Right.
But, in 2007, we were looking at these Western banks that, most people had never heard of that were going under. And it's like, so what? It was Golden West. And, I forgot the names of some of those banks. And a lot of people at the time were like, so what? It's just a small Western bank with, 10 branches, blah, blah, blah. Well, 6 months later, Bear Stearns is collapsing. And a few months after that, Lehman's going down. And companies like J.P. Morgan, Fannie Mae, AIG, a whole host of massive companies are falling. So, domino may start with a really small domino, but it can happen quickly. Like what they say about a butterfly's wings and hurricanes.
Yeah, and it's an interesting thing, because FTX isn't, theoretically isn't big enough to take down financial markets. But again, now we're talking about the Genesis exchange. It's potentially on the verge of bankruptcy. You put out a piece in this morning's daily commentary talking about Coinbase. Which is interesting because Kathy Wood at ARK has been loading up on Coinbase shares over the last couple of weeks. But, its bonds are pricing at 50 cents on the dollar. And that's with its bonds pricing at 50 cents on the dollar, that suggests that there's potentially rising bankruptcy risk even with Coinbase.
Right. And here's something very important for our listeners to understand. Coinbase is a custodian, just like Fidelity and Schwab. Mm-hmm. The difference is that Fidelity and Schwab segregate their asset, the securities. So they're not, and they can't use your money to make loans. Coinbase is using deposits to make loans.
Right.
They have access to your securities. Fidelity and Schwab don't. The risks are 100% different. There's no reason to even link the two as similar type entities, other that they're in the same industry.
Yeah, and in fact, Coinbase even made that statement. There was some talk about exactly this issue. I guess about 2 months ago, we actually talked about it on the show. But Coinbase said, "Hey, in the event of a bankruptcy, your assets actually belong to Coinbase, and we can settle, debtor claims with your currency. So in other words, Mike's got a Coinbase account with $100,000 worth of Bitcoin in it in a bankruptcy. In theory, now I'm not saying this is going to happen, but in theory, and what Coinbase alluded to was that they could use Mike's $100,000 to settle with their creditors. So Mike loses his $100,000 to solve a debtor problem for Coinbase. And so again, to Mike's point, Fidelity, Schwab, they can't do that. They're custodians. Those are entirely different deposits, segregated deposits. And in the event of bankruptcy, not only does Fidelity and Schwab and all these others carry SIPC insurance, which is the Securities Investor Protections Corporations Act, and that provides coverage up to $500,000, $100,000 worth of cash, $400,000 of securities in your brokerage account. But then these brokerage firms, because they want much bigger deposits, right? They want the guy with $2 billion to have his assets at Fidelity. They provide hundreds of millions of dollars worth of excess coverage in terms of an insurance policy, so that in the event of bankruptcy, your money is protected, right? And that's not the case potentially right now with these crypto custodians, at least not at this point. I think this will become an issue, Mike, after we get through this FTX debacle and we get, more regulation put in. We'll probably see the same custodial arrangements applied to these crypto exchanges.
I agree 100%. And if you have money deposited at Coinbase, that's considered a loan to Coinbase. So just, think about that. You're loaning money to Coinbase at 0%. You could just go buy their bonds at 15%. It's the same pecking order in the event of default.
Exactly. Actually, you may be better off because now you're a debtor of the company.
Will come first.
Yeah.
Right.
All right. Quick break. We'll come back, pick up on our conversation with Michael Lebowitz. Don't go away.
The Real Investment Show.
So talking about housing prices just for the break with Michael Lebowitz got me to look real quick for some data. And this is really interesting because this just goes to show you how screwed up we've messed with the markets in the last 12, 15 years. 1960, median home price was $11,900. Price growth from 1950 was 31.7%. 1970, the median home price was $17,000. Price growth was 42%, up from 1960. So this is by decade. So we're just looking at decade over decade. We can look at inflation-adjusted prices as well. The inflation-adjusted median home price was $104,000. That's today's dollars. Back in 1960, it's $112,000. So the median home price only grew over a decade in inflation by $2,000. So just keep that in mind. 1980, median inflation-adjusted home price, $147,000. Now, this is that inflation push Mike was just talking about a second ago. Price growth was up 87%. Inflation and real estate tend to go together, so not surprising there. 1990, but again, we're at $147,000 on an inflation-adjusted household. So now we're 1990. Houses go up by another $10,000. So the median house is $157,000. At that point, and the average interest rate is 10%. Now, also at this point in time, you still have to put 20% down on a mortgage. So you have to put 20% down. There was no second mortgage and all that nonsense in your median. And this was my original mortgage rate when I got a mortgage was 10%. So I remember those days. In 2000 now, this is where Greenspan comes in and says, everybody should afford a home, and we need to do adjustable rate mortgages. And this is where we introduce the split mortgage, where you get 80% primary mortgage, a 20% secondary mortgage to avoid PMI. This is where we start getting into low down payments. Interest rates are continuing to fall. So in 2000, the average mortgage rate's 8.1%. Split mortgages, home prices go to $179,000. So a fairly significant jump. Home price growth up 120%-ish. 2010, median home price is now $263,000. So now you're starting to see this escalation in home prices as people are taking out these just rate mortgages. We're getting more people into homes, taking on more risk and leverages. Now we just remember we've also gone through the dot-com crash here. But home prices are now 263%. The average interest rate on mortgages is now 4.7% in 2010. 2020, the house prices fly. We're now $336,000 for a mortgage. with interest rates at 3.1%. So you can see this acceleration in both the prices of homes, sizes of homes also getting bigger, but the amount of debt that's having to come in to the economy for the average homeowner to Mike's point, to buy just a median home, it's $300,000. The average income is about $56,000. The average family in America, that bottom 80%, make less than $100,000 a year. So this whole debt problem, and where I'm bringing this back to is what we talked about earlier. The Fed's here hiking rates. The Fed hiked rates in March of this year, a quarter basis point. They then hiked rates by 50 basis points. They then hiked rates 4 more times by 75 basis points. That gets us through the meeting 2 weeks ago. They're going to hike rates 50 basis points in December, 2 more times at least of 25 basis points in 2022 before they stop. Now, out of all those rate hikes, only one, that original quarter basis point hike, has actually impacted the economy yet. All these other ones are backlogged, and they take about 9 to 12 months to show up in the economy. So these 4 rate hikes of 75 basis points each, that's 3 full percentage points, just those alone. That 3% increase in rates is not going to hit this debt-laden market until early and mid next year. So the risk of an economic downturn or a recession being much worse than people expect. There's a lot of calls for a recession, but don't worry, it's a mild recession. Just a little trinkle of a recession, that's all. There's a big risk that it may be a lot worse than that. Mike, your thoughts?
Well, there's also another thing that we haven't talked about. It's not just, consumers and the government. There is what's called a wall of corporate debt coming due in 2023, 24. And basically, there's a lot of bond maturities for corporations. There weren't that many comparatively in 2022, but in 2023, a lot of debt needs to be rolled over.
Yeah, so it's, just to put a number with it, Mike, it's $1.6 trillion starting in June.
Okay, so what's, I think a lot of people think, okay, a company borrows money for 5 years and then they build a factory and then they pay off the debt and it's all gone. It's not the way it works. They roll over debt. They keep debt. Very few companies actually pay down debt to any substantial amount. Most companies roll it over. So they borrow money for 3 years. 3 years comes up, they borrow again. So when they do that, they're essentially borrowing long term, but in 3-year increments in that case. And they are become very dependent on interest rates. And why not? Interest rates have been, extremely low for a long time. They got used to it. Well, now there's a huge wall of debt coming up in, like, what'd you say, June of 2023, in another 6-7 months. That's going to be refinanced at 5% plus versus 2%. That's going to hit corporate bottom lines on top of a weakening economy. Mm-hmm. And that is why corporations, this is the lag effect. We're still 6 months away from this happening, and corporations are going to have to refinance. They're going to refinance at, say, 5 or 6 or 7%. Their interest expense is going to go up by X. To account for that, they're going to have to lay off people. They're going to have to not invest in new products. They're going to do something to try to make up for the higher interest expense. And that's your lag effect from the corporate balance, just the corporate balance sheet side. There are so many different lag effects that we could talk about, but that's one of them. And that's a big one that in 6 months we're going to hear a lot about.
Yeah, and we've talked about this before. One of the big risks of all this is in that small cap, that Russell 2000 space. And there's a lot of calls right now that small caps are going to perform great next year. They've really been underperforming. They're going to outperform next year because they perform better in a recovering economy. And it's interesting. You have a good tweet from our friends over at Kailash Concepts this morning in our daily commentary talking about, after the biggest bubble in history in the financial markets, 40% of the Russell 2500, that kind of small to mid-cap space, doesn't turn a profit. And it's hard to imagine after, everything that we've been through, all this money coming to the economy. And this is where a big chunk of those companies that you're talking about, what we call zombies, right, they're dependent on debt, of issuance of debt to service the debt they already have. And they're dependent on low rates to do that. So there's a big risk that, if the Fed goes too far, hikes too much, and breaks something, that we could see a rash of bankruptcies potentially in that small to mid cap space as debt becomes, that refinancing of debt becomes, much more difficult.
And this ties back to subprime. Subprimes were a small percentage of the mortgages outstanding. These small cap companies are not a huge percentage of the corporate world, but they start defaulting and it weighs on banks, it weighs on investors and pension funds, endowment funds, all the different types of investors. And it can work its way through a system due to the massive amount of leverage that is, to be honest, no one knows how much leverage there is. It's not fully calculatable. Mm-hmm. It's very underappreciated. So, what starts off as a little problem in one little niche part of a market can really multiply, right? It doesn't have to be crypto. It can be small cap companies. It can be something else. If we don't appreciate the leverage or the amount of debt outstanding, the amount of risk being taken, then we can't appreciate the potential consequences of much higher rates. And I think, Lance, we keep talking about the lag effect is such a big deal, and no one seems to be talking about it. No one seems to understand that these rate hikes are just beginning to scratch the surface of the damage they're going to be doing.
Yeah. And look, maybe we're wrong. Maybe there is no lag effect this time.
Hopefully we're dead wrong.
Yeah, hopefully we're dead wrong. That would be great. And we can just go buy stocks and it'll all be good. And look, Mike, you and I have had this conversation before, and I think it's very important that, for everybody listening to us right now is that, look, we're just trying to analyze the data for what it is. Is it possible that next year that we could avoid a recession and have this fabled soft landing in the economy and none of this stuff that we're talking about happen and everything is peachy keen and the Fed drops rates and the bull market just takes off? And sure, it's possible. There's absolutely a possibility that could be the case. It's probably a very small possibility, but it's possible, right? I mean, I played the lottery. I thought I might win, but I didn't. But there was a possibility I could have. And I think we have to keep that in the back of our mind in terms of managing a portfolio. We always have to at least accept the acknowledgement of a possibility and provide some room for that in the portfolio allocation.
And quite honestly, read people that are bullish, read people that don't think this is coming. Try to understand why they think that. Mm-hmm. It either helps build conviction in your case, or it helps you understand that there are odds that you're wrong and trying to understand what those odds are. Yep. Right? We may be sitting on an 18 and a dealer is showing a 5 in blackjack. That's a great position to be in. But, we've all, not all of us, but we've lost money playing that.
5-card Charlies happen all the time. So, absolutely. All right, Mike, thanks so much. That wraps up the show for the day. Get by the website, realinvestmentadvice.com. Our latest blog post is out discussing exactly a little bit of what we're talking about here, which is why monetary policy, the tightness of it, suggests that we may have some more work to do first in this market before we get to the next bull cycle. But that is on the website now, realinvestmentadvice.com. While you're there, send your questions, comments, emails. Get our daily commentary. I just mentioned the chart from Kailash Concepts that's in today's daily market commentary. If you want to see it, just simply click on the link right there on the homepage. Make sure you're subscribed. We email that out every morning at 7:30. Also subscribe to our weekly newsletter right there, right next to it, just to the right. Just click that button and subscribe. We'll take good care of you and make sure you get all the information you need to manage your money better. Realinvestmentadvice.com. See you back here tomorrow.